You know, thinking of the stock market, it's a bit like the seasons changing, isn't it?
Take a bit of it.
Sometimes it's bright and sunny, everything's growing, that feels like a bull market, prices climbing.
Yeah, lots of optimism.
Then you get those colder, quieter times, things pull back a bit, the bear market. And, well, you wouldn't argue with winter trying to make it summer.
Ha. No, you definitely wouldn't. You adapt.
Exactly. So today, our deep dive isn't really about predicting these market seasons perfectly. It's more about figuring out how to invest wisely, whatever the weather.
Precisely. And the main tool we're looking at for navigating these, well, inevitable ups and downs is the systematic investment plan, or SIP.
Right, SOPs.
The research we've looked at really points to how investing a set amount regularly can be surprisingly effective for building wealth long term. Doesn't matter if the market's soaring or dipping.
It's funny, isn't it, that desire to be the genius who buys at the absolute bottom and sells right at the peak?
Oh yeah, everyone wants that.
But the sources we looked at, they basically say nailing that consistently is, well, almost impossible. Like finding that pot of gold.
Pretty much. It suggests there's a different path, one that's maybe less glamorous, but much more dependable.
Okay, so what are we digging into?
Well, we'll unpack how these market cycles actually work. Then why trying to time them is usually a fool's errand.
Okay.
And then how this disciplined approach, specifically using SIPs, can really be a solid strategy no matter what the market's doing. And we'll definitely touch on the psychology, the emotional side of investing too.
Good, because it's huge. So let's start with the cycles. Bull markets, our source paints a pretty clear picture, right? Rising prices, lots of investor excitement.
Yeah, real buzz. Everyone feels like they should jump in, ride the wave up.
And the flip side? The bear market.
That's when prices are falling, sentiment turns cautious, maybe even fearful. And that fear can, lead to people selling at the wrong time.
But the key point from the source is both are normal.
Exactly. They're just part of the market's natural rhythm, the ebb and the flow. Successful investors get this.
Right. So you don't fight it. The advice is don't try to change the market weather. Just learn how to, put on the right coat.
Adapt to it. That's the core idea.
Yeah.
Which brings us back to that temptation, timing the market.
Ah, yes. The siren call of buying low, selling high. Sounds simple.
Sounds simple, but the source is pretty blunt. Consistently achieving it is almost impossible.
Like catching lightning in a bottle, maybe. You might get lucky once.
Exactly. You can't build a reliable strategy on luck. So if timing isn't the answer, what is?
Discipline.
That's the word the source keeps coming back to. Discipline.
Yeah.
The power of a consistent, systematic approach. Investing a fixed amount regularly.
Okay, and this connects to something called Rupee cost averaging. Sounds a bit technical.
It does, but the concept is pretty straightforward. Let's say you invest a fixed sum, maybe $5,000 every single month.
Okay.
When the market price of your chosen fund is high, that $5,000 buys you fewer units. Makes sense, right?
Yeah, things are expensive.
But when the market dips and the price is lower, that same year of Oros buys you more units.
Ah, okay. So you automatically buy more when things are on sale, effectively.
Precisely. Over time, this averages out the cost you paid per unit. You avoid putting all your money in at a potential peak. It smooths out the ride.
Which leads us straight into why SIPs are seen as this all-weather strategy. How do they manage that?
Well, it's that Rupee cost averaging in action. In a bull market, prices are up. Your SIP buys fewer units.
Right.
In a bear market, prices are down. The same SIP amount buys more units.
So the SIP is automatically doing that buy low part for you to some extent without you needing to guess.
Exactly. It takes the guesswork and a lot of the emotion out of it. You're accumulating more when investments are cheaper, less when they're expensive.
It's like a built-in discount mechanism over the long run.
That's a great way to think about it. And the end result, over years, is often a portfolio bought at a better average cost than if you tried to time lump sum investments.
And there's another benefit mentioned, the habit.
Oh, absolutely crucial. SIPs instill that discipline of regular saving and investing. It becomes routine. And that removes a lot of the worry about, is now the right time, giving you mental peace.
Okay, but investing isn't just about numbers and habits. Our source really flags the emotional side, these emotional investment mistakes. What are we talking about?
Well, the big ones are fear and greed, basically. Fear makes people sell in a panic during downturns, locking in losses.
Right, when things are cheap.
Exactly. And greed, or maybe FOMO, makes people pile in when the market's already high, driven by hype or news headlines.
It's almost backwards, isn't it? The classic advice is buy low, sell high. But our emotions often push us to do the exact opposite.
That's the trap. We see red, we want out. We see green, we want more, often too late. Understanding this and managing our reactions is vital.
The source suggests really knowing yourself, your biases.
Yes, and sticking to your plan, your strategy, regardless of the noise.
And this is where the SLP really shines again, maybe, as a sort of psychological tool.
Definitely. The source talks about how SIPs create a routine, like brushing your teeth or having your morning coffee. It becomes automatic.
Less room for impulsive decisions based on yesterday's news.
Right. It depersonalizes the decision in a way, and it removes that constant burden of when should I invest.
Yeah.
That decision is made, it's regular, it's systematic. That cuts out a huge source of anxiety and potential error.
And seeing that cost averaging work over time, even through dips, must build confidence.
It does. It provides what the source calls mental reassurance. You start to see that investing during downturns actually pays off when the market recovers. That helps dial down the fear factor.
Let's dig into some of those specific emotional traps. FOMO, fear of missing out. We hear that a lot.
Yeah, you see your neighbor or someone online bragging about huge gains on some hot stock, and you feel that pull.
Got to get in on that.
Exactly. Often without doing your homework. You jump in late, maybe near the peak. SIPs, being steady and planned, help counter that urge. It's about the long game, not chasing quick clicks.
Then there's loss aversion. That idea that losing hurts more than winning feels good.
Yes, psychologically, losses loom larger. This can make investors too timid. They might sit on the sidelines even when opportunities look good because they're scared of another loss.
How does SIPs help there?
By investing gradually, you're not putting a huge chunk of capital at risk all at once. Accumulating smaller amounts regularly, even buying more when prices dip, feels less risky and helps overcome that paralysis.
And just the sheer noise, news headlines, market commentary, the source mentions overreacting to news.
Oh, absolutely. News cycles are 20/47, often dramatic. It's easy to get spooked or overly excited by short-term events.
But this SIP just keeps going.
The SIP is systematic, it's pre-planned, it doesn't read the headlines or care about the daily chatter. It executes the plan, providing insulation from that noise and preventing those knee-jerk reactions.
So it really helps shift focus from reacting constantly to planning.
Exactly. The source emphasizes moving from reaction to a planned approach. Reacting is often emotional, short-sighted. Planning is strategic, long-term, focused on your goals.
And planning requires patience, which the source called, what was it? The most rare but precious asset in investing. Why is patience so hard with money?
Well, we want results now, don't we? Especially when markets feel volatile. It takes nerve to stick with it when things look grim. But wealth building takes time. Compounding needs years.
SIPs kind of force patience on you in a good way.
They encourage it, definitely. By continuing to invest through downturns, you're implicitly betting on the long-term recovery and growth, which historically has been a good bet.
There was that example in the source, starting SIP just before the 2008 crash. Ouch.
Yeah, terrible timing on the face of it. The
Yep.
portfolio obviously went down significantly at first.
But they stuck with it.
He stuck with the SIP, kept investing regularly through the downturn and the recovery. And by 2014, the returns were substantial. It's a powerful lesson in staying the course.
That really drives home the point about investing being a journey, not a race.
Absolutely. It's not about getting rich quick. It's about consistent steps. Like a marathon runner setting a steady pace. SIPs are built for that long haul, using small, regular contributions that add up and compound over time.
And it's not just about having the money, but the strategy. The mountaineer analogy was interesting, needing planning, balance, not just strength.
Right. Success isn't just about how much you invest, but how you invest. SIP gives you the systematic plan. But you still need the balance.
Which brings us to choosing the right investments for this SIP, right? Asset allocation. You can't just SIP into anything.
No, definitely not. The source stresses this. What you invest in matters hugely. It depends on your goals, your time horizon, your risk tolerance.
So, for example?
Well, for long-term goals, say 10 years plus, maybe retirement or kids' college down the road, equity funds might make sense via SIP for their growth potential.
Okay. Shorter term.
For medium term, like 3-5 years, maybe a balanced fund, mixing stocks and bonds, could offer a middle ground. And for very short-term goals, less than 2 years, you'd likely want something safer like debt or liquid funds to preserve capital.
So it's about matching the investment type to the goals, timeline, and risk. Diversification, even within the SIP framework.
Exactly. Proper asset allocation is key for managing risk and creating a portfolio that's more resilient across different market cycles.
And life changes. So our investments probably need a checkup occasionally. Portfolio review.
Yes, the source recommends looking things over, say, every 6 to 12 months. Your goals might shift, your income could change, you get older. You need to make sure your SIPs and your overall allocations still fit your life.
Doesn't mean you have to tinker constantly, though.
Not at all. Often no changes are needed. It's more about awareness, ensuring things are still on track, and making adjustments if necessary. Staying in control.
I like the idea of the SIP being like a wise friend during market cycles.
It's a nice analogy, isn't it? Because it does the sensible thing. Automatically buys less when things are pricey, buys more when they're cheaper. It helps lower your average cost without you needing to stress about timing.
Like a dependable buddy, just doing the right thing in the background, not getting caught up in the drama.
Exactly. No panic, no hype, just sticking to the plan. And this consistency, the source argues, builds more than just wealth. It builds mental fortitude.
How so?
By living through the ups and downs with SIP, by sticking to the plan and seeing it work, you learn discipline. You learn to stay calm when others panic, stay cautious when others get greedy. You build resilience.
That mental strength sounds almost as valuable as the financial returns.
It's deeply connected to achieving real investment success, which, as the source points out, isn't just about the final number.
Right, it's broader.
It's about reaching those life goals, maybe buying a home, educating your kids, retiring comfortably. It's about financial freedom, security. And SIPs offer a path towards that without needing huge capital up front or becoming a market expert.
So that final thought from the source was quite powerful, viewing each SIP payment, whether it's 500 or 5,000, not just as money.
But as a resolution, a deliberate choice to take charge of your financial future, to lay the groundwork for your dreams.
A commitment to rise above the daily market noise and emotional swings.
Yes, embracing discipline and foresight instead.
The analogy of the boat navigating storms felt apt too.
Yeah, market conditions will change, sometimes drastically, but a consistent SIP approach, like a steady hand on the tiller, can help you reach your financial shore if you bring trust, patience, and that crucial discipline.
So wrapping up, it really reinforces that investing is this lifelong journey. It's not a quick dash.
And a systematic investment plan. It can be a really loyal and effective companion for that journey. Definitely something to consider seriously for your own financial planning.